Ladies and gentlemen, welcome to Entrepreneurial Finance, Selection of Venture Capitalists. Now, you have a great business idea, you had already financing from business angels, now you'd like to have more money to grow your idea. How do you select your venture capitalist? I mean, we learned how a venture capitalist selects you, but how do you select a venture capitalist? Do you do that? Certainly, you select a venture capitalist. I mean, you like to sell lemonade, and do you get money from these guys? Maybe not, but if so, if you have offer from all those venture capitalists, which is the one you like to select? Do you have an idea? It's better to take Sequoia, the entrepreneurs behind the entrepreneurs, or European founders, the founders behind the founders? Well, let's look at this a little closer. What are basic selection criteria you can use in order to find the right venture capitalist for you? Start with the name and reputation of venture capitalists. And this is a very tough selection criteria. It's probably easier in the US than in Germany or the European countries. In the US, it's very clear, or it's pretty clear that there are some very, very successful venture capital companies. And they have a reputation for being successful. A good example is Sequoia Capital. Sequoia Capital, especially with Michael Moritz, has a great history in venture capital investments. They do it for a very, very long time, and they did great investments and great exits, actually. So it's pretty clear that Michael Moritz and all the other guys, they have a good network, they have the ability to push companies towards success, and they know when to sell and when to do the good exit. So having such an investor in your company, being venture backed by such an investor, is probably very, very positive for you. Are there the same examples in Germany? 3i, for instance, is a good example for a venture capitalist. It has a good track record. However, they also had investments which failed. I mean, every venture capitalist has investment that failed. So it's always worth looking into the portfolio of the investors and look at the companies there and look how you know the companies and whether you think this might have a reputation also for you. It is easier to look at all the other criteria. Maybe a second one is with a reputation. Do these guys have experience in founding businesses? So it is really entrepreneurs who build the venture capitalist because they normally have the better network, or is it more like those former investment bankers, consultants who built their venture capital firm? Second, the development phase of your own company. Not every venture capitalist invests in each stage. Some do seed investments, some do growth investments. We already saw that difference. If you approach a venture capitalist, the venture capitalist is not doing seed investment and you are very early, he's not going to invest in your company. Same with the industry sector. Venture capitalists, especially in early stages, love to focus, actually have to focus in order to reduce information asymmetry for themselves. Having said that, they won't invest in every industry. If it's a clean tech investor, they invest in clean tech. They probably won't invest in internet. Maybe if it's some clean tech idea, but I can't imagine that right now. So this is also difficult to get. Required financing volume. Venture capitalists sometimes have very specific ideas on the financing volume they do. So you might want to look at that too. And you might want to look at the location of the venture capitalist, because it's still that the venture capitalist normally wants to be at the portfolio firm within 2 hours. That's the rule. It might not be true always, but it's probably hard to convince a US-based venture capital firm doing the seed investment to your company. They won't do that. If you have a seed investor, if you have venture capital on board, if this company is running, you might get a venture capitalist from the US because they say, okay, additional support is not that required anymore. So this is 5 criteria you might look at if you select the venture capitalist on your own. Most importantly, or most difficult, is name and reputation, and all the others you can probably Google, or you can look on the European Venture Capital Association's website and search on that and find all the venture capitalists and make your long list and your short list by looking at these criteria. Going further into that topic, you can see, for example, this slide, that not every venture capitalist invests in every stage. Especially if you're in seed stage, you won't find so many venture capitalists who's doing these early investment. You might be better off also getting more business angel involvement before you approach a venture capitalist. If it's startup, you might find more, and especially in expansion, you might find more. This is also a very tricky question for you as an entrepreneur, because normally textbook knowledge would be go to a venture capitalist because you need money. This is probably not the right answer. Try to understand your business. Try to understand how you can be profitable. When you understood this, you might approach venture capital, because at that stage, venture capital can really help you to scale your business. Venture capital, especially with the idea on risk return, because they have to drive your risk in order to drive their return, they might not want to wait until you have understood the market, you've understood your path to profitability. So they might push you into markets, they might push you into too many markets too early before you have a good understanding. So what we can see in practice is that there is a couple entrepreneurs who raised venture capital when they were already profitable, when they've understood their business, when they understood, for example, in the internet, the relationship between customer acquisition cost and customer value. If you know how you can make more customer value with and lower customer acquisition costs. So if you understand, if you can make money, at least on a variable basis, with each additional customer, then you can approach venture capital, because then venture capital can help you scaling your business up, making it a very successful, scalable business model. Fostering your understanding, it might be questionable if a venture capitalist, especially with his investors in the background, so his fund running out of business, wants to wait that long. So this is why venture capital in seed stages might not be that interesting. In startup stages a little more, but before you have a good and solid understanding, try to come along with business angels. They can wait longer, and whenever you understood your business, then you can go on and expand your business. And this is normally the sweet spot for venture capital, and it's actually also the sweet spot for you. So please keep in mind, it is not about raising money because you need money. It's about raising money because you want to scale your business. That's the sweet spot for you and the venture capitalist. And this is also what you can see, for example, in Stanford Business School, what they tell you. Final tips for choosing the right venture capitalist, they basically tell you, negotiate from a position of strength. If you're a profitable business and you want to scale the business, if you found that sweet spot, you can wait. You have a position of strength. That's always better to have. Try to be there before you approach venture capitalists. And then you can make a lot better deal, actually for both of you, for you and the venture capitalist, because then they really can run their business model too. Pay more attention to the partnership than the terms. All the terms are always for the case of failure, of the case anything goes wrong. You don't want anything goes wrong. You want a partnership for success. So the partnership, first of all, is most important. However, terms are not unimportant. So we have more slides concerning the terms, and you should pay attention to that. However, first of all, venture capitalists should be your partner in expanding your business based on your own understanding. Find shared beliefs. So you have to believe in the business as the venture capitalist has to believe in the business. And this is your shared belief, shared vision. Maybe you might not know everything, but you have a common vision. That's important. And the last one, listen to your instinct. If you don't think it fits together, you might keep your fingers away, because there's many success stories of venture capitalists, but there's always stories where venture capitalists didn't play nice to entrepreneurs. And even if you listen to the Hotmail story, if you look into the Hotmail story and their relationship to Draper Fisher Jurvetson, they don't always tell you it was the best relationship, and they weren't too happy with all the terms in the contract. So you might, before you approach venture capital, you might also look at those examples more closely.